The financial markets are buzzing with excitement as the Dow inches closer to its historic peak and the S&P 500 soars following a robust jobs report. This is a crucial moment for everyone interested in the economy. But what does all this mean for future market trends? Earlier this Thursday, a strong jobs report enhanced investor confidence, boosting stocks, bond yields, and the US dollar. This came in the wake of a shortened trading session for the July 4th holiday, with the Dow leaping by 344 points or 0.77, the S&P 500 climbing by 0.83%, and the tech-focused Nasdaq Composite advancing by 1.02%. Both the S&P 500 and Nasdaq reached new all-time highs, while the Dow was merely 186 points shy of its record. The market rally in the morning was driven by a promising update that showed the US economy created 147,000 jobs in June, surpassing expectations. The unemployment rate dropped slightly from 4.2% to 4.1%. These impressive figures brought a sense of relief to investors who'd been anxious about economic deceleration due to the tariffs imposed by the president that threatened trade dynamics. The June jobs report felt like a blockbuster movie, full of excitement and surprising turns. Despite the tariffs, political hurdles, and global headwinds, the United States labor market has delivered a performance that exceeded expectations, stated Gina Bolvin, president of Bolvin Wealth Management Group. However, while the market surged, there's an air of caution among investors. The specific breakdown of job growth reveals a less optimistic scenario, particularly with weaker performance in the private sector, according to Jim Baird, Chief Investment Officer at Plant Moran Financial Advisors. There is a note of caution to consider, Baird commented. The hiring trends in the private sector could have been relatively low, which stands as a significant detail to keep an eye on. Job growth wasn't evenly spread across all sectors, and the average period of unemployment increased. Moreover, the proportion of long-term unemployed individuals, those jobless for 27 weeks or more, edges towards a 3-year peak. Bearing in mind the global trade issues, tariffs, and the tax policies being debated in Congress, businesses appear reluctant to hire. This cautious sentiment has likely influenced the June statistics, said Baird. The jump in treasury yields reflects investors' reduced expectations for potential rate cuts from the Federal Reserve. The 10-year yield rose to 4.34%, and the 30-year yield increased to 4.86%. The US dollar also strengthened with its index, measuring its strength against 6 major foreign currencies, rising by 0.45%, marking its best daily performance in nearly 2 weeks. This jobs report is a win for the economy and corporate profitability because it signals no looming recession, noted David Russell, Global Head of Market Strategy at TradeStation. Uncertainties about tariffs and trade haven't scared off businesses from laying off workers. The last week saw the Dow, S&P 500 and Nasdaq all closing higher. The job market's resilience provides the Fed with time to maintain current interest rates while keeping a close watch on inflation trends. Looking ahead, traders are now anticipating only a slim 4.7% chance that the Fed will cut rates in July, a significant drop from the previous 23.8%. Recent weeks have seen mounting scrutiny on the Fed's approach to rate cuts, especially as President Trump has intensified his criticism of Fed Chair Jerome Powell for keeping rates steady. Sina Shah, chief global strategist at Principal Asset Management, mentioned that June's jobs report suggests that rate cuts in July are now unlikely. Today's strong payroll data and a reduced unemployment rate, along with fewer jobless claims, put to rest any immediate need for Federal Reserve intervention, Shah noted in an email. As developments unfold on Capitol Hill concerning the passing of Trump's One Big Beautiful Bill and negotiations on a trade front, investors remain vigilant. Notably, President Trump recently announced a trade deal with Vietnam. The stock market starts the second half of 2025 on a promising note, reaching record highs as investors factor in the diminishing uncertainty of tariffs and remain optimistic about tax cuts and economic stability, said David Lout, Chief Investment Officer at Abound Financial. Chris Zaccarelli, Chief Investment Officer at Northlight Asset Management, expressed his encouragement about the recent stock market recovery, though he raised concerns about high valuations and the possibility of markets being more vulnerable to negative developments. With extreme greed prevailing according to CNN's Fear and Greed Index, its strongest reading in over a year, there's certainly a lot to consider moving forward. What do you think? Are the current market valuations justified? Or are the markets setting themselves up for potential pitfalls? Share your thoughts in comments.